In today's video, I want to touch on expensive companies that I would love to buy, but only if they dipped or crashed, meaning that those are quality companies that are trading at expensive prices. Of course, with markets at all-time highs, with plenty of stocks reaching their own all-time highs on a weekly basis right now, the list can be quite long. But in this video, let's touch on 4 stocks, maybe actually 5, because I'll add a bonus company as well. The names will pop up on the screen right now. The order here doesn't really matter, so we're going to talk about Shopify, Axon, Arm, Ferrari, and then the bonus one is Hermes. I hope you keep watching. And if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. We also recently talked about 5 quite good European stocks, European companies that is. I know Europe might not be as sexy as the United States, but the companies that I covered in that video aren't your, well, small-ish whatever company. No, those are companies that have been here for quite a long time and I believe will be here for a long time as well. So do check that out. That will be in the top right corner. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So company number 1 we're going to talk about is Shopify. Now, just because this is the number 1 company we'll talk about in this video does not mean that this is the number 1 on the list, or the most expensive one, or the one that I love to buy if it dips. The list here doesn't matter. So Shopify. Shopify right now has a market cap of close to $150 billion. Year to date, the stock is now up close to 50%, with the, of course, recent jump in share price being the reason for that. The last earnings report was a very good one. Now, Shopify, of course, in the last 3 years, just like plenty of other growth stocks have had, well, not the best 3 years, let's say. The stock peaked at the end of 2021, and then, well, it completely crashed, I believe, over 70% or so. They also made an acquisition for the logistics side of the business that didn't work out. They sold it, and then the stock did rebound because the business did rebound. Free cash flow wise, this is becoming a free cash flow generating machine. Now currently it's trading at a forward PE of 81.9 times. We're going to see what it means compared to the 5-year mean. Looking at what the analysts are expecting this business to do, top line growth for the next coming fiscal years above 20%. EPS for this year growing 81.6%. That's because last year was quite a weak year. Then fiscal 2025 EPS growing 14.4% and then another 25.2% year-over-year growth in fiscal 2026. If you look at the average analyst price target right now, that sits just 2.5% higher than the price we're at today. And then looking at some other pricing metrics compared to the 5-year mean, you can clearly see we are below the 5-year mean. So you might ask yourself, oh, so why is it on the expensive list? Well, just because it's lower than the 5-year mean does not mean that it is cheap. As you can see, previously this company was also not that profitable, so you have to take that into consideration. Now we've seen what analysts are expecting this company to do with regards to revenue growth for the next coming fiscal years, but what about free cash flow? Well, free cash flow for fiscal 2024 is expected to grow 70% year over year, followed by 27.7% in fiscal 25, and then another 25.8% in fiscal 2026. So that's quite impressive growth with regards to free cash flow. Overall, the business has done this. Over the last couple of years, of course, well, it has been quite something to see Shopify grow this fast. Here, we've seen a huge acceleration in growth because of the pandemic. So overall, you've got revenue, you've got a split between subscription and merchants being the largest part. Then looking at GMV and GPV, GMV is the green bar, GPV gross payment volume is the blue one. Here as well, you can see huge acceleration during the pandemic and, well, continued growth after that as well. The line here is monthly recurring revenue that has also increased quite quickly in the last 2 years. Overall, if we look at gross profit margin, yes, it has come down a little bit from, well, 10 years ago where it was at 58.8%, but we're still sitting here above 50%. The company is generating way more revenue, way more profits, and way more free cash flow now than before. And as you see, this is basically the weakest point for Shopify. Free cash flow went into negative territory, and then we see an acceleration in free cash flow. We're now at a free cash flow margin close to 17%. And so if we do a quick reverse DCF here, we plug in the trailing 12 months free cash flow, terminal growth rate, discount rate, we can see that to justify today's price, free cash flow is expected, well, should be growing closer to 24% each year for the next 10 years. Now, you might think, okay, this is quite a lot, which, okay, fine, but we've seen that in the next 2 fiscal years, it's expected to grow around those rates. Can they continue to do that? That's another question. If we say, look, maybe 20% makes more sense, then the stock will have to drop 26% to around $85.76. Maybe that's when the price is looking much more attractive. What do you think? Moving on to company number 2, and that's Axon Enterprise. And this is probably one of the most no-brainer stocks that I should have bought in the last couple of years. Because I've known about Axon for the last couple of years. I've also seen that crime is rising. So it was basically a no-brainer. But right now, as you can see, this stock has had, well, quite a run-up, which makes sense because as you will see with the business has grown quite fast as well. It's a market cap close to $50 billion, a forward PE of 112.2 times. Year to date, the stock is up 151.3%. If you look at what the analysts are expecting this company to do in the next coming fiscal years, in fiscal 2024, that's right now, sales growth of 32.7%, followed by 23.2% and 21% in fiscal 25 and fiscal 2026. EPS also growing quite quickly, 26.2% in fiscal 24, close to 20% in fiscal 25, and then an acceleration, 25.6% year-over-year growth in fiscal 2026. Looking at the average analyst price target, that sits 7.9% lower than the price we're at right now. And then looking at the pricing metrics here, comparing to the 5-year mean, you can see that it is more expensive right now than before on all of those. And so here as well, let's look at what free cash flow is expected to do in the coming fiscal years. In fiscal 2024, free cash flow is expected to grow 66.9%, followed by 100 and let's call it 15% in fiscal 2025, and then another 39.1% in fiscal 2026. So it's expected to grow quite quickly, more than triple in the next 2 fiscal years. Looking at how they generate revenue. So you've got Taser revenue, which is the blue bar right here, and software and sensors revenue. You can clearly see that in the last, well, couple of years, growth has accelerated for software and Taser. And then you get to split those two into product revenue and services revenue. Services revenue has grown much quicker, well, in the last, 8 years or so than a product. And of course, when you have software and services, margins are quite high. What's also impressive here is if we look at the net revenue retention, that continues to go up. We were at 119 for, well, a long time, 2020 to 2022, and then it started to go up. We stayed at 122% for a while, and now we're at 123%. Another thing here is the software as a service annual recurring revenue. Like I said, software types margins is, well, quite good to have, especially if you also have hardware. And here we can see the SaaS annual recurring revenue that has grown by 525% since September 2019 and more than doubled in the last 2 years. And so here as well, let's do a quick reverse DCF. We can see that the implied growth rate sits at 35%, which is quite high. I mean, yes, we've seen that in the next 2 fiscal years, that shouldn't really be an issue, but can it do that for the next 10 years? That's quite something. That's quite a lot. So here as well, I would like to take it down to, let's say, 20%. And if it's 20%, then, well, the stock will have to go down by 67%. Now, of course, you can change here the terminal growth rate, the discount rate, and all of that. You can do that. I'm just using here the 10-year yield, and then the discount rate is basically the implied equity risk premium plus the terminal growth rate right now. So yeah, this is quite expensive. You can say 20 is maybe a bit too low, so let's do 25. Even that, the stock will basically have to split in half for it to become more attractive, let's say, or maybe cheaper. It might never happen. Okay, then I guess we'll never buy it. Up next is a company in the chip industry, and that's ARM Holdings. Now, ARM is really something special because they do play a very, very crucial part in the semiconductor ecosystem. But this stock has never been that cheap. Yes, of course, you can see that there were some dips to be bought. That's fine. But even then, it was not really cheap. I mean, currently it has a market cap of $152.4 billion, a forward P of 81.1 times, and EV to sales 33.8 times. Now, yes, this is a company that is expected to grow quite quickly, above 20% in the next coming fiscal years, and EPS actually growing faster than that. In fiscal 2025, EPS growing 22.3%, followed by above 30% growth in fiscal 2026 and fiscal 2027. But again, this is a company with a market cap of $152.4 billion, and in fiscal 2025 is expected to generate, let's call it, $4 billion. Currently looking at the average analyst price target, that's basically the price we're at right now. And then looking at some pricing metrics compared to the 5-year mean, here again, all of them are above the 5-year mean. Price to earnings, EV to EBITDA, is quite close. Then price earnings to growth at 2.46. So again, very, very good company, not cheap at all. Looking at what free cash flow is expected to do in the next coming fiscal years. So in fiscal 2025, currently it's expected to be down 31.5%, but then growing 184.2% in fiscal 2026, and then another 31.1% in fiscal 2027 to $2.54 billion. Looking at how they generate revenue, royalties, and licensing and others. So we've had royalty revenue grow by close to 50% since 2021. License and others has grown by close to 120% since. If we look at where the revenue comes from, the biggest chunk comes from the United States, then we've got the People's Republic of China, then Taiwan, and then Korea, with Taiwan revenue growing the fastest of the bunch here at 70% growth since 2021. If we look at remaining performance obligations, I mean, you would have thought for it to be much, much higher than that, right? With the momentum that ARM designs should have, Qualcomm and all of that, you would have thought that maybe the jump would have been much bigger. Okay, it's up 36.2% since 2022. Let's see what happens in the coming years, especially since ARM is expected to be, well, more competitive with x86, with Intel, with AMD. Remains to be seen what happens with that, because currently, if you look at all the reviews, well, yes, maybe some performances, some benchmarks are better than the other, but not everything is compatible currently with ARM. Maybe the next Windows 12 is going to be designed to be compatible with ARM devices from the start. Okay, then that could be definitely a game changer. But all in all, ARM really sits at, I would say, the center of, or close to the center of the semiconductor ecosystem, a very, very important company. No wonder that NVIDIA wanted to acquire them. I mean, would have been one hell of an acquisition, right? Because now it's worth $150 billion, so, or maybe not worth. Now, if we do a quick reverse DCF here for ARM, yes, this is probably the most expensive name in the video. So to justify today's price, approximately, it will have to grow free cash flow by 37.5% for the next 10 years. And this is quite a lot, unless, of course, something drastically changes with the semiconductor industry and ARM does get a lot of momentum. I mean, this is quite high. This is a quality business with world-class margins and all, but 37.5% free cash flow growth for the next 10 years is definitely high. Now, even if we put it at 30, right? Let's give them 30. Well, I would probably be a buyer maybe at $85. And even then 30% is still quite high. But then again, we don't know what will happen, when the stock might crash. Maybe free cash flow in the last 12 months is going to be much higher than that. So we basically have to base ourselves on what we know today, and this is what we know today. Moving on to company number 4, and that's Ferrari, ticker symbol RACE, probably one of the best tickers to have as a publicly traded company. Now, Ferrari has a market cap of $78.29 billion, a forward P of 47.8 times. Year to date, the stock is up around 30%, also pays a small dividend. Now here, as you can see, this is not a company that's expected to grow sales by 20% or something like that. No, sales for 2024 is expected to grow 5.4%, followed by 7.8% and 8.6% in fiscal 25 and fiscal 2026. EPS growing a little bit faster than that. Currently looking at the average analyst price target, that sits at 13.5% higher than the price we're at right now. And then looking at the pricing metrics comparing to the 5-year mean, here as well we can see that it is more expensive. Forward PE, EV to EBITDA, price to sales, price to free cash flow, and even price earnings to growth, that's quite high, 3.76. Now looking at free cash flow growth, we can see that in fiscal 24, free cash flow is expected to be down 25.8%, then followed by 26.1% growth in fiscal 2025, then 12.4% in fiscal 2026. All in all, this is how they generate revenue. The majority comes from cars and spare parts, then sponsorships, and then, well, engine revenues has come down quite drastically throughout the year. But if you look at the growth from 2020, I mean, even here the pandemic helped them, it seems like. Lots of people have made quite a lot of money since, because revenue from cars and spare parts has basically doubled. Where does the revenue come from? Well, largest part here is from the rest of Europe, Middle East, and Asia. Then we've got Americas, then rest of APAC, mainland China, and Italy sits at, well, last place. Doing a quick reverse DCF here for Ferrari, we can see that the implied growth rate sits around 16.5% to justify today's price. Now, of course, this is much lower than the rest that we've seen, but this is a company that's not expected to grow that quickly. So here, I would probably take it down to 12% or so. That would mean that the stock will have to come down 30% to make it more attractive. But then again, maybe it will come down 30%, but by then free cash flow might be higher, might be lower. Rates here might change as well. So there is that. But overall, yeah, this is basically it. It's a bit expensive. Maybe you should be buying the car rather than the stock. Who knows? Maybe that might be the play here. And now as for the bonus pick, that's Hermes. We did talk about LVMH in the European video. So Hermes has a market cap of 237.6 billion euros, has a forward PE of 49.3 times. Year to date, the stock is still up 19.5% despite all the headwinds and despite everything that we've seen in the luxury market. Why is that? Well, Hermes is just in a league of their own. If we look at the expected growth rates for this company, about the same top and bottom line, above 10-11% or so. But yes, in fiscal 2024, EPS is just expected to grow 2.4%, but then it's expected to accelerate 12.3% in fiscal 25, then another 13.6% in fiscal 2026. Looking at the average analyst price target, that's basically at the price we're at right now, which is 2,269 euros. Switching to the pricing metrics here, comparing to the 5-year mean, forward earnings is, let's say, a bit lower, but not by much. All the rest are higher than the 5-year mean. Price earnings to growth sits at 5.39. And just as a reference here, for example, at the end of 2021, price earnings to growth was at 2.62. So yeah, this is never really cheap. What's expected to happen with free cash flow? Well, free cash flow in fiscal 2025 is expected to grow 19.5%, followed by 14.5% growth in fiscal 2026. How do they generate revenue? The majority comes from leather goods and saddlery revenue, then readywear and accessories revenue, other Hermes sector revenue, silk and textiles, perfume and beauty, and then watches revenue is quite low right now, and the rest is basically other products. All in all, this is a company with extremely high gross profit margins, right? We can see this right here, above 70%. Overall, it's quite clear gross profit goes up. It's true that free cash flow margin has come down a little bit. It did peak here around 32% or so. Now it's a bit closer to 27%, but I mean, still quite high. This isn't a software business. This is still luxury goods. Last quarter, these were the results, and we can actually see that, well, Europe was doing quite well. Total Asia, fine, 3.5% growth, but the majority of it coming from Japan. That's because the currency there was quite weak, so it made sense to go there and buy luxury goods. Overall, okay, 10.1%. That's quite good. Here, the biggest hit with regards to the, well, sectors, the products, The biggest hit comes from watches, that's down 8.2%. And so there you have it, the 4 stocks plus the bonus one. Which one is on your watch list, and at what prices are you willing to open a position in these types of companies? If you have other stocks you want me to discuss that are quite expensive today, yes, maybe Palantir and stuff like that, we already know those names. Maybe some others, let me know down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye bye.